morning, friends. I hope all of you are well. Yesterday, RBI held its Monetary Policy Committee meeting, and many decisions were taken. So you might have seen many news articles and many videos about RBI Monetary Committee meeting and its decision. But I have brought a comprehensive coverage of all RBI, what is RBI, about RBI Monetary Policy Committee, and also the main highlights of the decision. So let's get started. So first we'll see what is RBI Monetary Policy Committee. So RBI Monetary Policy Committee, it is a committee constituted by central government and led by governor of RBI. It was formed with the mission of fixing the benchmark policy interest rate, that is repo rate, to restrain inflation within the particular target level. RBI governor controls the monetary policy decisions with the support and advice of the internal team and the technical advisory committee. Committee comprises 6 members, 3 officials of the RBI and 3 external members nominated by the government of India. Governor of RBI is the chairman ex officio of the committee. Decisions are taken by majority vote, with governor having the casting vote in case of a tie. Current mandate of the committee is to maintain 4% annual inflation until 31st March 2026, with an upper tolerance of 6% and a lower tolerance of 2%. So let's know about something about the brief history of the MPC. Initially, the main decisions related to the interest rates were taken by Governor of RBI alone before the establishment of the committee. With Mr. Raghuram G. Rajan, who was the 23rd Governor of the RBI, he was there between September 2013 and September 2016. So we all know about the friction between Mr. Rajan and government, Modi government at that time. There was differences on many of the issues. So MPC was constituted to resolve that problem. Actually, the RBI, though it is a independent body and it has powers under the Constitution of India, but they have to work in sync with the objective of the government also. But if there is friction, it is going to be harmful for the country and the financial system of the country. So it was a good decision, I will say, because resting so much of power on one person, and especially the things which matter so much for the economy, might have been dangerous. So government conceptualizes this committee. It was formed under RBI Act 1934 as an initiative to bring more transparency and accountability in fixing the monetary policy of India. The Reserve Bank of India Act 1934 was amended by Finance Act 2016. Now MPC conducts meetings at least 4 times a year, and the monetary policy is published after every meeting, with each member explaining his opinions. Before the constitution of the MPC, a technical advisory committee on monetary policy with experts from monetary economics, central banking, financial markets, and public finance advised the Reserve Bank on the stance of monetary policy. However, its role was only advisory in nature, and the decision of the RBI governor used to be final. Now that system has been replaced by the MPC. Now we'll see the formation of MPC, how it was formed. The setting of a committee to decide on monetary policy was first proposed by Urjit Patel Committee. The committee suggested a 6-member MPC, 3 members from the RBI and 3 nominated by the government. The government initially proposed a 7-member committee, 3 from RBI and 4 nominated by each. So you can see that government wanted to dominate, and they wanted to have an upper hand in the committee by having 4 members, and their decision would have been final. But later on, negotiations led to current composition of the committee, with external members having a 4-year term. Now, what is the composition of the current MPC? Governor of the Reserve Bank of India, he is Chairman ex officio, Mr. Shaktikanta Das. Michael Devrata Pakra, he is Deputy Governor of RBI in charge of the monetary policy. Mr. Rajiv Ranjan is executive director in the executive director of the bank in charge of monetary policy. So these are 3 members from the RBI. Now 3 members nominated by the government. Asima Goyal is a member of Prime Minister Narendra Modi's Economic Advisory Council. Ms. Goyal is a professor at the Indira Gandhi Institute of Development Research in Mumbai and was a visiting fellow at Yale University. Another member is Shashanka Vide. He is a senior advisor at National Council of Applied Economic Research, a New Delhi-based think tank whose work has involved research into agriculture, poverty analysis, and macroeconomics. Jayant Verma, the last member, is a finance and accounting professor at the Indian Institute of Management, Ahmedabad. He was formerly on the board of the country's capital market regulator. Now, we see what is monetary policy and how it is used. So, monetary policy is a process of regulating the supply of money in the economy by the monetary authority of the country. Who is monetary authority of our country? It is RBI. The monetary policy generally adjusts the inflation rates or interest rates to sustain the price stability and to maintain the predictable exchange rates with foreign currencies. So RBI is the central banking authority. Let me go back a bit. RBI is the central banking authority of India, which controls the monetary policy in conjunction with the central government's developmental agenda. So they are working as per the agenda, the development agenda of the government. The Reserve Bank of India is authorized to make monetary policy under the Reserve Bank of India 1934. So this power has been granted by Constitution, not the government. Monetary policy is either contractionary or expansionary and is often seen separate from fiscal policy, which deals with taxation, spending by government, and borrowing. When the total money supplies increase rapidly than normal, it is called an expansionary policy, while a slower increase or even a decrease of the same refers to contractionary policy. So now we'll see what are the instruments of monetary policy, what are the tools RBI has to implement the monetary policy and the decisions. So there are both direct and indirect instruments used for implementing monetary policy. I will mention a few here. They are repo rate, reverse repo rate, liquidity adjustment facility, marginal standing facility, bank rate, cash reserve ratio, statutory liquidity ratio, open market operations bonus, and market stabilization scheme. So if you want me to explain these terms, if I will start explaining, the video will be very long. If you want to know about these rates, you can comment in the comment section, and I will make fresh videos to explain these rates. Let's move on. Now, the objectives of the monetary policy. What are the objectives? We have seen the tools, we have seen the purpose. Now, what are the objectives? What monetary policy want to achieve? So, monetary policy was implemented with an initiative to provide reasonable price stability, high employment, and faster economic growth rate. So, these are the main targets. So the 4 major objectives of the monetary policy are mentioned below. They are to stabilize the business cycle, to provide reasonable price stability. Price stability is very important for the economy, to provide faster economic growth, and exchange rate stability. So if the exchange rates are not stable, if they are fluctuating either ways, then that will be very harmful for the economy. So the monetary policy, you can see it has very big objectives, and they are very important for the economy. So that's why so much of emphasis and importance is placed on the monetary policy, and it is watched keenly by all the market participants. Now we'll see what are the recent RBIMPC meeting highlights. First, RBI has kept benchmark rates unchanged at 6.5%, so it has not changed the repo rate. It proposes to enhance UPI transactions limit for payment to hospitals and educational institutions from Rs 1 lakh to 5 lakhs. So now you can pay more to these hospitals and educational institutions. Up to 5 lakh you can pay now. Hikes GDP growth projections for current fiscal to 7% from 6.5% earlier. ex-GDP growth in December and March quarters at 6.5% and 6%. We have already surpassed the estimates in the first and second quarter, so we'll be able to achieve the growth projections in the current financial years.
Yeah.
Retains average retail inflation projection at 5.4% for FY24. Inflation outlook to be considerably influenced by uncertain food prices. Intermittent vegetable price shocks could once again push up headline inflation in November and December. Rupee exhibited low volatility compared to its emerging market peers in 2023. Relative stability of the rupee reflects the improving macroeconomic fundamentals and its resilience in the face of formidable global tsunamis. The rupee has exhibited very strong opposition to the slide other currencies are facing in face of the dollar. As forex reserves stood at $604 billion as on December 1st, RBI remains confident of meeting external financing requirements comfortably. RBI to remain vigilant and ready to act as per the evolving outlook. India better placed to withstand uncertainties compared to many other countries. Proposed to hike e-mandate for recurring payments to rupees 1 lakh from current rupees 15,000. RBI is set up a cloud facility for the financial sector to enhance data security and privacy. This is a major decision, and we also understand the implications and importance of this decision because of the recent breaches, especially UCO Bank, IMPS issue, and other cybercrime incidences in India. Next monetary policy meeting is going to be held between February 6 to 8 December in 2024. That was the last meeting for this year 2023. That was all about RBI and the monetary policy meeting. I hope this video will be helpful for you. It will be of value. And if you want any clarification, if there is anything I need to explain, you can comment to me in the comment section. And if you like this video, please like, share, and subscribe to this channel. I'll be back again with the latest financial news and updates. By the time, take care, friends, and goodbye. Thank you so much.